Well, good morning, everyone, and welcome. I'm Jim Rooney, President and CEO of the Greater Boston Chamber of Commerce, and we want to welcome you to our annual Economic Outlook event. All of us as people in the business community are navigating challenges and trying to find opportunities amidst a complicated political landscape. And when I speak to members of the Chamber about their businesses and the economy, the word that I hear most often is uncertainty. Yesterday we had an election day. We're still navigating a government shutdown and federal policies that impact the way that commerce is conducted. And of course, now we're heading into a holiday shopping season. For businesses and consumers, there are many planning and strategic decisions that need to be made as we strategize for the coming months and the next year. Every year, the Chamber hosts this Economic Outlook event to provide information that might help with that planning. And each year, we embrace a theme that feels right in the moment. This year, we'll focus on consumer behavior, not through poll results, but by hearing from people who see it every day in consumer-facing industries like banking, retail, hospitality, and groceries. We're often hearing conflicting and complicated anecdotes about the economy right now. How are consumers reacting, not just our Massachusetts residents, but the millions of people who visit our state each year? Our featured economist, Megan Shu, Chief Investment Strategist for Wilmington Trust, and our featured business leader, Lizanne Kindler, CEO of Knitwell, will offer us clarity in terms of the headwinds and the tailwinds with their presentations. With this complicated economic landscape in mind, the Chamber is still optimistic that Boston and Massachusetts and all the people throughout the state can find opportunity and success right here. Before we begin, I want to share a few notes about the program. This event is being recorded and will be shared on the Chamber's website and YouTube page. And I also want to give a very big thank you to our Economic Outlook. Please join me in thanking M&T Bank and Jeffrey Carpenter, Interim Massachusetts Regional President and Head of Specialty and Corporate Banking. Jeffrey is also on the Chamber Board of Directors, and you'll hear from him in just a few minutes. Because of M&T's generous support, the program today is free for all attendees. Now let me get started with a few introductions. First, I want to welcome and also express my gratitude to Renee Jones, Chairman and Chief Executive Officer of M&T Bank, who will moderate today's panel discussion. Under Renee's leadership, M&T Bank has more than $211 billion in assets and a network of over 900 branches. The bank's 22,000 employees take active roles in the communities they serve, providing capital for transformative projects, partnering with small businesses, volunteering their time, and working to make communities stronger and more resilient. In Renee's 30-year career at M&T, he has helped develop and lead many of the key functions since becoming CEO in 2017. The company has grown steadily, nearly doubling its assets. Please join me in welcoming Renee Jones. Next, we have Mark Iannotti, Chief Operating Officer of Stop and Compare Markets. Vivian Iannotti, the CEO of Stop and Compare, is unable to join us today as a panelist, but she, as his boss, she asked her husband, Mark, to step in. Mark is the COO of Stop and Compare Markets. Stop and Compare may not be a name familiar to some of you, but Stop and Compare Markets is a family-owned grocery chain serving Latino and diverse communities across Massachusetts. With a background in finance and business operations, Mark helped expand the company from its original Chelsea location into multiple stores, including 2 stores in Lynn. Under Vivian and Mark's leadership, Stop and Compare has focused on providing fresh, culturally relevant food options and revitalizing neighborhoods in need of accessible grocery stores. Please join me in welcoming Mark. Also on our panel is Patrick Lyons, co-founder and CEO of the Lyons Group. The Lions Group, a Boston-based hospitality company, has created more than 50 unique venues during its 40 years in operation. Through the years, Patrick and his team have entertained millions of Bostonians and visitors at his award-winning venues like Rochambeau, Sanssouci, Scampo, Summer Shack, just up the street, Lucky's, and dozens of others. The Lions Group restaurants and entertainment venues continue to create the vibrant pulse of the city and the region. Please join me in welcoming Patrick. And now I'd like to welcome Jeff Carpenter, M&T's Interim Regional President in Massachusetts and Chamber Board meeting, and today's sponsor, to introduce our presenters and keynote speaker. Jeff?
Jim, you might be recruited to be a spokesperson for M&T, because that was pretty good there. But as Jim mentioned, I'm Jeff Carpenter, Interim Regional President for M&T Bank here in Boston. I have both the privilege and responsibility to lead our 700-plus colleagues across the Commonwealth. And thank you to Jim and the Chamber for asking me to kick off today's event. It's wonderful to see so many leaders, partners, community members here to talk about what's ahead for our future here in Eastern Massachusetts. I have a great amount of gratitude for the Chamber, Jim. We've worked together for many years now and love the work that you do to help Boston thrive. This is M&T's 5th year sponsoring the Economic Outlook Breakfast event, not always a breakfast anymore. And I like to say it gets a little bit better each year. In true Boston form, we've got a great starting 5 here as panelists and speakers, and really look forward to the conversation focused on the consumer. Our mission at M&T is quite simple. You know, we focus on aspiring to impact the lives and communities we serve. And we really do that through 3 things, and very basically through capital, through people, and through ideas. Our people are some of the best in the market. As I mentioned, 700 colleagues, several new leaders in this room today helping M&T grow in Eastern Massachusetts. We dedicated over 7,300 volunteer hours in 2024 to areas of food insecurity, economic development, and housing. From a capital standpoint, obviously we can deploy our balance sheet, both equity and debt, to support affordable housing, small business lending, banking nonprofits, and issuing grants to support community partners in Massachusetts. And M&T actually was the number 5 SBA lender in the Commonwealth last year. And it was ranked in the top 25 of most charitable organizations in the state by the BBJ, with just over $5 million of financial contributions to community partners. When I say ideas, I really I think about Megan's role being a trusted advisor, showing up in our communities with thought leadership, with a network that we can create to support individuals and small businesses in our market. We have a vast network we can leverage for business owners and partners to navigate various challenges and opportunities that they face. One example would be the partnership we have with the Commonwealth. I'm looking for Kim Gainsborough-Brooks in the room. We've hosted several webinars with the Commonwealth that support small business owners and entrepreneurs over the years, and we've hosted over 100 this year, year to date. So really great work across the board. As we look towards 2026, today's program is going to bring together leading voices, as Jim mentioned, in retail and hospitality, financial services, to help us better understand trends shaping our future. From shifts in consumer behavior to the impact of federal policy changes, AI, global trade. I'm sure we'll talk about tariffs somewhere in the mix here. But the session's going to offer insights that are both timely and relevant. And it's my pleasure, as Jim mentioned, to introduce our speakers. We're fortunate to have 2 colleagues on the panel today. Renee Jones, our chairman and CEO, is going to lead the panel. And Megan Hsu from Wilmington Trust will kick us off on the economic update. Megan is the head of investment strategy and portfolio construction at Wilmington Trust. She's a regular CNBC contributor and frequently quoted in the financial media communicating the firm's economic and market views. Megan's responsible for helping manage the end-to-end asset allocation process, developing market research, and communicating the investment team's market sentiment. Prior to Wilmington Trust, Megan was an investment strategist at Bessemer Trust, where she helped manage asset allocation decisions, performed market research, and published pertinent thought leadership. Megan holds an MBA from the University of Miami and where she was valedictorian of her graduating class. She also holds a bachelor's degree from Princeton, where she was captain of the swimming and diving team. I mean, if that's not a well-rounded resume, I'm not sure what is. And lastly, to add more to the list, Megan was named to American Banker's Most Powerful Women in Banking in 2025. And she's a mom. Yeah. Lizanna Kindler, our keynote speaker today, is the executive chair and CEO of Knitwell Group, a multi-brand specialty retail company comprised of the iconic American apparel brands. You'll know most of these: Ann Taylor, Chico's, Lane Bryant, Loft, Talbot's, to name a few. Together, these brands generate $6 billion in sales, serve 20 million customers, and employ 45,000 associates across the country, making Knitwell one of the largest specialty apparel companies in the U.S. Outside of Knitwell, Lizanna is a highly respected leader in the industry and in the community. She leads Knitwell's efforts in the community they serve through partnerships at the national level with Dress for Success and the Breast Cancer Research Foundation, having raised nearly $100 million to support and empower women. In addition to her philanthropic work, Lizanna has served as on the board of the Boston Fed since 2020 and is currently deputy chair. So when we said we had an all-star crew today, we truly have an all-star crew. And with that, I'd like to welcome Megan to the stage.
All right, good morning. Thank you, Jeff, for that wonderful introduction. I'm so excited to be here today. The title of my presentation is Investing in a Rorschach Economy, which fits well with Jim's introductory remarks. Just by show of hands, who has actually taken a Rorschach test? So a few. For those of you who haven't, you probably know that it's based on the idea of an ink blot, and you can show two people the same ink blot, and they might see two very different pictures. And if you stare at that ink blot long enough, you might start to see some different things emerge as well. And that is precisely what we feel like we are dealing with in the economy today. We have tariffs, which continue to get spoken about on earnings calls and weigh on investment and hiring decisions. But we have second quarter GDP that came in at 3.8%, and the third quarter is tracking 4%. We have consumer confidence that is incredibly low, and I'll show some pictures or some ink blots on that. But consumers continue to spend. And then we have businesses that are a little bit worried about investment decisions, but the investment fever around AI continues at a robust pace. So what I'm hoping to do today is to show you that ink blot and tell you what we see in the pictures through all of our very careful analysis. And I'll start with the takeaways, just in case anybody wants to tune out for the rest of the 14 minutes that I'll be up here. We do have, I would say, a cautiously optimistic view of the economy in the short term. We are more optimistic longer term, mostly related to our view that we are in the early innings of a productivity resurgence. But in the short term, we are in the midst of a bit of an economic slowdown, notwithstanding the GDP figures I just mentioned. And we have what I think is an uncomfortably high probability of recession over the next 12 months at about 45%. We do think that the Fed has more room to go in its rate cut cycle. We expect 2 more rate cuts this year, another 3 next year to get to the Fed's neutral rate. And that should lead to a steeper yield curve as well. Now, I am not actually an economist. I hate to disappoint you all. I'm a strategist. So I look at the economy and then I bring it back to markets. So I could not help but throw in a little bit of commentary on how we're thinking about positioning our client portfolios. And in the short term, the market has had a remarkable run, but we do think we are primed here for a little bit of a pullback. Nothing that is out of the ordinary and nothing that really drives or should drive any sort of profit taking. We think you should ride through that, but we think that that actually could be a healthy development for the market. You need a little bit of a pause to reset for the next part of this cycle. And so for our clients, we are recommending that they stay fully allocated to equities. So let's look at the biggest economic picture that I can give you, which is the GDP data. As I mentioned, we do have second quarter GDP that came in at 3.8% after a very disappointing first quarter. And the third quarter is tracking about 4%. So we have a bit of a slowdown from last year, and we do think that we are going to have what I'll call subpar or sub 2% growth for next year as well. What is interesting is that we do have estimates that about half of the growth that we've seen from the economy this year is attributable to AI-related spending on the data center and infrastructure build-out. So you're going to hear the two-speed economy in a couple of different ways. It relates to the consumer. It also relates to what we're seeing just at the broadest economy, which is we have a lot of spending and enthusiasm around tech, a little bit less momentum in other parts of the market. I'll talk about private demand, which is the portion of GDP that we really care about the most. It's consumer spending and CapEx. And you can see that we had a little bit of a dip earlier this year. And we had about a 50-50 probability that we were going to continue to move lower and have recession. We've since pulled back our recession probability to less than a coin flip, about 40 to 45%. And that's mostly because we're seeing a re-acceleration of private demand, both on the consumer side as well as the CapEx side. Again, this is masking a little bit of a two-speed economy as it relates to the consumer. The high-end consumer continues to do very well, more correlated to performance of the stock market, and responsible for an inordinate share of spending in the economy. Whereas the lower-end consumer is showing a little bit more strain, a little bit more reserve as it relates to consumer spending. So tariffs. Tariffs have been a headwind to the economy and to confidence. And as it relates to inflation, when we were really talking about tariffs earlier in the year, there were a lot of concerns that they would be stagflationary, which is to say that they would mute or slow growth and lead to higher prices. What we are seeing is a little bit more of the stag and a little bit less of the inflation. Here I am showing 3-month annualized inflation for core goods, services, and then core inflation overall, which is the dark blue line. The teal line is core goods. There we are seeing an acceleration or a pickup in inflation. And this is because tariffs have more of an impact on the pricing of the goods part of our economy. We're monitoring a little bit of an uptick in services, but we do not think that services inflation will pick up in the same way as goods. And there's a couple of reasons for that. First, it's interesting how companies are handling tariffs. We're listening to a lot of earnings calls. A lot of research shows that companies, a little bit different than 2018, they are passing some of the price increase through to consumers, and that's why you're seeing core goods moving up and to the right a bit. But they're also sort of taking an all-of-the-above approach, and they're taking some of a hit to their own margins, as well as taking the price impact of tariffs and shifting it around their portfolio, if you will. So if there's certain parts of their portfolio that maybe are more exposed to high-income consumers who can absorb that tariff increase, even if that good is not being tariffed, they might move the price over there. Or if there's a more price inelastic good, they might shift the tariff impact there. And for the most part, companies are doing a very good job of managing this so far. We are aware that inventories were built up. We might not have seen all of the impact of tariffs thus far, but we do know that for all of the the drama around the April 2nd announcements of tariffs, we are looking at today, based on what's coming in and being collected, an effective tariff rate of only about 10 to 11%. So not really anywhere near where those headline figures were. It's still meaningfully higher than where we were last year or really at any point over the past few decades. But our view is that this is a one-time increase in prices. Consumers are going to pull back from the services part of their spending to pay for goods, and therefore we will not see inflation pick up in the services part of the economy, which is good news for the Fed. Now, the other side of the Fed's dual mandate is the labor market and full employment. And here we're a little bit less constructive or maybe a little bit more concerned and watching this very closely. But again, here the ink blot comes into play. So on the left, I'm showing new job growth, and you can see that it has slowed dramatically, basically to stall speed. And if you look at the private sector, that's the chart on the right, outside of healthcare, we have seen a decline in job growth for 3 out of the last 4 months. So we are seeing job growth in less cyclical parts of the economy, like healthcare, and more job contraction in small businesses and in the cyclical parts of the economy. We are in a bit of a data desert right now because of the shutdown, and that is making us rely a little bit more on private sector data. We did get an ADP report today that showed about 40,000 new jobs created in the past month. Now, this seems like a low number, but again, this is to bring it back to the Rorschach test. We are in a very different labor market than we were last year, specifically as it relates to the supply of labor. We are bringing in a lot fewer immigrants, documented and undocumented, and as a result of less labor force growth, we should expect to see less job growth. So whereas we got quite accustomed to 100,000, 200,000 net new jobs, and it's been a bit of a shock to see numbers like 20,000, 25,000, or even 40,000, that is closer to the run rate just to keep the unemployment rate steady, which is to say if we were creating about 25 to 30,000 net new jobs every month, we would see the unemployment rate stay at about 4.3%. That's still a low number when you think about the impact of job growth on spending and all of the trickle-down effects. So it's not necessarily a super constructive picture for economic growth, which is why we have about sub 1% GDP growth expected for next year. But it also means that we are in a bit of a new labor market where we shouldn't expect really, really robust job growth. So what does this mean for the Fed? As I said, we do think that the Fed is going to watch some of the weakness that we're seeing in the labor market and recognize that inflation continues to gradually move lower and that tariffs are going to be a one-time price change, not endemic inflation that they really need to be worried about. And so we see the Fed cutting 2 times this year, 3 times in the first half of next year to get to a neutral Fed funds rate, or the Fed funds rate that neither stimulates nor contracts the economy, and that should be supportive to some of the more cyclical areas of the economy. So I just want to talk a bit more about the consumer, because that's our theme for today. Consumer confidence has been very interesting to watch. Here I'm showing 2 different measures of consumer confidence. What's fascinating is that today we are at or below where we were in COVID, which is very difficult for me personally to square. Now, consumer confidence has always had a very loose relationship with spending, but even more so today, something after COVID broke any relationship that there was. So confidence is very low, but we are seeing consumers continue to spend. And so it's a bit of a watch what they do, not what they say type of dynamic. And I would say a little bit stark and surprising that in this economy, especially compared to COVID, we are looking at very, very low confidence numbers. This could be a function of a very politically charged environment, inflation fatigue, you name it. But I would caution that low confidence does not necessarily mean consumers will be really retrenching from spending. Interest rates, very important for the consumer, for borrowing, especially as it relates to the housing market. There is a pretty close correlation between the 30-year fixed mortgage rate and the 10-year Treasury yield, and we have seen the 10-year pretty anchored over the past few months, couple years even, at about 4%. So mortgage rates have come down recently to about 6%. The problem is that even with the Fed cutting rates, we have this lingering fiscal problem for the US that is keeping the long end of the Treasury curve elevated. And so we think outside of a recession, 4% for the 10-year Treasury yield is probably in the ballpark. For housing, what that means is that we don't see the mortgage rates coming down meaningfully. And while a 6% mortgage rate is more attractive than it's been over the past couple of years, about 50% of existing mortgages still have a rate below 5%. So if you don't move mortgage rates to or meaningfully below 5%, you don't really loosen up a lot of that existing housing, and affordability continues to be challenging, especially for first-time home buyers. I'll talk a minute about credit, which there has been a lot of headlines over the past year or so about credit concerns, all-time high for credit card debt for consumers. What's interesting is that if you normalize credit card debt by income, the aggregate consumer has a lower debt-to-income level than they did before the pandemic. So in aggregate, household balance sheets are actually in pretty good shape. Now, we've been watching the increase that you can see in delinquencies for credit cards, for auto loans, a much more modest increase in delinquencies for the mortgage market and for housing. Fortunately, these are starting to roll over. So this is a good thing. We've seen a bit of a plateauing in delinquencies for credit cards and auto loans. We obviously have a very, very sharp uptick in student loans. They tend to be a smaller portion of the aggregate debt balance out there, so something we're watching but not terribly concerned about right now. But again, I think this is constructive for the consumer, and if we get the job market moving again and picking up even slightly, I think this gives us a chance to have another bit of a reacceleration of economic growth in 2026. So just to bring it back to markets real quick, and then I'm going to pass it to Lizana. We have seen a very strong period in equity market performance. The S&P 500 is up about 18% year to date. It has been a remarkably strong 6-month period. If you look at the market performance since the low on April 8th through until today, it's been one of the best 6-month periods in the market on record. It stacks up with bouncing off the bottom in the global financial crisis and COVID. So the momentum has been incredibly strong in the equity market. That has helped the high-income consumer who has more exposure to stocks and whose spending is more tied to what the stock market is doing. But I would also draw your attention all the way over to the left, to the performance of gold, which is it's a funny asset class, but I think when I look at the outperformance of gold, I see a little bit of caution on behalf of investors. To me, this outperformance of gold is the best depiction in the market today of those low confidence numbers that we looked at earlier, where there is a little bit of hedging going on. All told, we do think we are in the little bit of a slowdown with a reacceleration to come in 2026. Fed rate cuts should help. We do think that productivity, specifically around AI, is very early innings. And this is something that longer term we are quite constructive on. We are advising our clients to stay fully invested today with a little bit of more of an eye towards higher quality companies with really strong earnings and low leverage, as well as taking a little bit of precaution in fixed income and skewing more towards investment grade rather than high yield. So with that, I would love to invite Lizanna up to give a little bit more color from her perspective.
Thank you, Megan. I appreciate it. Good morning, everyone. Thank you to the Boston Chamber of Commerce for inviting me. It's great to be here this morning, and a beautiful New England morning, which we love. I am gonna I'm gonna introduce myself quickly just in terms of Knitwell Group. So you guys heard that Knitwell Group has a bunch of vertical retail specialty brands in the portfolio. So we're a rather large company in the sense that we serve 20 million women, and we've got about 2,800 stores across America and an e-commerce business that's about $3 billion in demand. So one of my favorite topics is actually to talk about the consumer because I, in many ways, could say that I get a scorecard on behavior every single day when I look at our business. And I also, in some ways, could say I have a front row seat to how she thinks about spend. And we all know that GDP is very dependent on consumer spend, and women drive a lot of the spend. So I'm going to touch on 3 topics, and I'm going to actually kind of elaborate on some, or maybe go deeper on some of the topics that Megan was talking about, and I'm going to maybe provide a little bit of color in terms of how we see the consumer and what she's saying. So I'm going to talk about this thing about sentiment versus behavior. You know, what is she saying and what is she doing, and this resilient consumer that we keep talking about. I am going to touch on tariffs and prices because it does matter in terms of how we think about the outlook. And then I'm going to talk a little bit about outlook. I am not an economist either, but I have some thoughts about where we're going. So let's start with this puzzling fact that Megan talked about, which is we see the sentiment, right? I think the Michigan survey is sitting just over 50, as Megan showed, and yet we see the GDP numbers come in. I think good is what we would say, right? The 3.8 and Q3 looks to be another good quarter. So what's happening under the covers in terms of this feeling and this sentiment versus how she's spending? So it feels like for us, when we talk to our customers, she very much illustrates this sort of paradox of spend versus behavior. She feels good about her own situation and her own household. I would just point out that most of our consumers sit in the 110 to 170,000 household income. We do have one of our businesses that touches 75,000, so a lower household income. But for the most part, when we ask our customers, they feel good about their own financial situation. She's working, her wages are solid, her home value is high, we just talked about that, and she's kind of feeling good about her 401k, she's invested in the market, like things for her look good. But then when we ask her about her outlook and how she thinks about the macro picture, her sentiment is very, very different. She's worried about the macro state of the economy. She's worried about prices going up. She's worried about the geopolitical situation, and the news cycle is feeding some of that as well in terms of just her feeling of unease. So in some ways, she's saying, I feel good about my own situation, but I don't feel good about the macro situation. So I think this disconnect that we're seeing between sentiment and spend and this idea that we have a resilient consumer is very much about how she feels about her own situation and her ability to continue to spend versus when she looks at the economy or the macro situation and she doesn't feel as good about that. Now, there's a lot of nuance in that. And of course, at the highest level, that all sounds great, right? Spend is continuing to materialize. But when we click down, there is a lot of nuance, and a couple of things that I want to touch on that I think are interesting. So one, we talk about income level. And I think that is very, very important. That is a distinction. We just heard Megan say that high household consumers feed the spend. I think it's a stat like top 20% of income feeds 50% of the economy and the spend. So on the other hand, the low household consumer that we have, when we talk to her, she doesn't feel so good about her own situation as well as she doesn't feel good about the macro. She's worried about grocery prices. She's worried about utilities. She's worried about her medical costs. So she feels less good, and the way that we see that manifest itself in our business, we have to pull on prices a lot. She's very price sensitive. And one thing that has helped us here is actually gas prices. When gas prices are not high, it helps her budget. It helps how she thinks about her spend. So we're watching gas prices very closely, and that's been helpful for us when it comes to this particular segment of our business. But she is less resilient and much more sensitive to changes in any of these factors when it comes to price. The other click down that we do often across our businesses, we look at age. Different segments of consumers, different sentiments. And one that I want to point out for all of you is that we're watching very closely is the baby boomer segment. So this is an interesting segment. Two of our businesses serve what we call the baby boomer customer. And she feels pretty good about her own situation, but she is very reactionary to what happens in the environment. Many of them are retired. They're on a fixed income. They have time to watch the news. And the news cycle really matters to her. We see this very specifically in our business. So I'll give you an example. The first quarter, where we had the inauguration, we had executive orders, we had DOGE, we had tariff talks, we had Liberation Day. To her, that was a very, very noisy quarter, and we saw her pull back on her spend. So it wasn't so much about her own situation, it was about what she was watching and observing in the environment. So she started to pull back on her spend. Now, the good news is, when all of that started to quiet down, and we can debate how quiet it is, but when it started to quiet down, she came back very, very quickly and started spending again. So she is quite resilient, and I think of her as maybe a bit of a sign of the economy in many ways, where there's noise and you see a little bit of a pullback, and then it kind of evaporates, and then consumers are back spending. So she is someone that we're watching very closely because she gives us a good insight as to the mindset of how consumers are thinking about what's happening in the macro environment. Now, the last point that I want to make when we click down and we think about behavior and we think about our customers. We know, of course, that having a job and making a wage feeds spend. So when we look at our consumer, our customer in our portfolio, 70% of our customers work. They are now back more in person. They might not love that, but we actually like that, because when consumers are out on the go and they are in person, they think about what they wear. They want to look good. They're back spending. Now, we see this in an interesting way, of course, in particular to our business, is suiting sales are up, pant sales are up, blouses are up. So we can see how it starts to feed the way that she's thinking about her spend. So feeling good about her job is important. And her wages is very important to how she spends. There is this phenomenon that I think we've all lived through and we've seen, right? We went through this great resignation moment, and now I think we are sitting in I think it's termed the job hugging moment, where a lot of employees are now staying put in their jobs. They're showing up more in person. So there's a stability factor which does impact how she thinks about her spend and is a positive when we look at it with our customers. The one little nuance there, I would say, is that when we talk about job hugging, it is obviously also because it's not as easy right now to switch jobs. So the question is, what does that mean for the go forward in terms of our customer? At least I think about, like, is she going to stay in her role? Is she going to continue to make more money? Wages have kept up nicely. What's going to happen now that we're not seeing as much turn? So we're staying very close, and some of our customers are starting to say to us when we analyze or when we engage with them on surveys that they're a little worried about their own job security right now. So that's something that we're watching very, very closely. So all of this only to say that at the high level, it looks like sentiment is low. There is this since COVID phenomenon that we've been watching. It's not really correlated to how she necessarily feels and how she's spending, our customer, but when we click down, we see different mindsets and different behaviors by segments that we are definitely watching very, very closely. So I'm gonna kick over to prices and tariffs, because of course global trade and tariffs is very, very top of mind for us in the clothing industry, where most of what we do, apparel, clothing, and accessories, are really imported. So I love this low effective tariff rate. That's not exactly the one that we're, ours is a little bit higher than that, I would say, based on the countries that we import from. But having said that, of course, prices impact the way consumers behave. And so when we look at our customer, and you guys all both know this from studying the economy, but also just from yourselves, consumers are tired of prices. They are exhausted by prices. They're exhausted by prices going up. So what does that mean when we think about pass-through of prices to our consumers? We're being very, very thoughtful. We're being very thoughtful about how we navigate this situation, because we can only pass through as much as she's willing to accept, right? If she's not willing to accept it, we're not going to get her business. So it's a bit of a puzzle that we're trying to solve into and get a feel. Different segments, different household incomes, different categories, how are we solving into it? But it is something that's very important. Now, on the flip side, what we've also learned from our customer is the value proposition is not always tied exactly to the price. So when we think about what we can control and when we think about how we solve into this situation, part of what we're thinking about is, why is our customer shopping with us? How do we keep her happy, and how do we amplify even further what makes us a special place for her to engage, right? We don't compete on price, and with tariffs, we have to be very thoughtful about prices. But what we can do is we can go after the things we do control: the quality level, the service level, the relationship factor that we have with our customer. And that's only to say that tariffs is impacting lots and lots of businesses. But I think going back to the core of what is your value proposition as a business is something that becomes even more important in this moment as we're trying to solve for how much can we pass through? How are we going to solve to the cost pressure that we're now feeling with the tariffs? So on the outlook side, I'm going to turn to outlook. We talked a lot about the resiliency of the consumer. And I think, again, I'm not an economist, so I hope that we don't enter a recession. I look at the numbers and I can see where we can get there in terms of the lower probability on the outlook. I think of two things. One is the amount of uncertainty that we've all been living through in the past 5, 6 years. I don't know, it feels like forever. The amount of uncertainty, I don't think it's going to go away. I think it influences how we all think about our businesses. I think it influences our ability to make decisions and how much we commit to when we think about hiring, when we think about investing in projects and capital spend and inventories. But it's kind of a fact of the environment that we're living in, and I don't think uncertainty is going to go away. I look at it on the flip side, and then I say, okay, well, there are some very positive things that are happening as well. One is maybe tariffs isn't going to have as big of an impact on the economy as we might have all thought in the first place when it was introduced. So watching that very closely. Consumers continue to be resilient and adaptable, and they find ways to figure out where to go and spend their money. That's good for the economy. AI is a factor that we're all leaning into to think about, like, how does that create efficiency for all of us? And does that give us an opportunity to think about how we're structuring ourselves and help us solve into how we become better as we go forward? So I do see that there's optimism too. So I think it's like this cautious optimism feels right. Now, I feel like we've been saying that for years, at least I have, this cautious optimism, but that's a reality of what we're living with. So when I think about the outlook, I go back to the word resilience, and I think about companies and leaders, all of us, being resilient, right? We have experienced over the past 5+ years since the pandemic, the ability to adapt, the ability to change the way that we're doing business, the ability to lead people in a different way and think about, like, where are our strengths and what can we get out of it. So when I think about the outlook, I think about the fact that consumers are resilient, but so are companies and leaders. They are resilient, they do adapt, they do change, and they do figure out how to navigate the situation. And I think that is in our own control, and that's very, very much what we're focused on when I think about the business that we're running and the outlook that we have. Like, how do we feed into what we control, and we as a company and us as leaders be resilient? So I'll leave you with that.
Well, good morning, everyone. It's really fantastic to be here. I was thinking years and years ago, growing up in Ayer, Massachusetts, when I was delivering the Lowell Sun throughout downtown Ayer, I would have never imagined that someone would invite me up here to the Boston Chamber. And then I look over next to me and I see a guy from Buffalo, and it all starts to make sense. I delivered the Lowell Sun. What did you deliver?
I delivered the Buffalo Courier Express morning newspaper.
Yes. So it all I'm sure we probably have others, but I won't go.
Providence Journal. I'm from Rhode Island.
That's fantastic. No, we've got a great panel, and I think about what we've done here today so far. Megan sort of took us through the macro and the sort of K-shaped economy and the differences. And then, Lizanne, you brought it a little bit closer down to what's happening underneath. And I think right now, based on our panelists, we're really going to get right to what's actually happening with the customers. And so I think it's very well designed, Jim, and I appreciate being part of it. I'll just start off by saying we've talked about it, but we see very similar things. We see corporations are very, very healthy. We see that they actually have access to capital, and very cheap capital. But at the same time, we attribute most of that to the consumer. And so as you kind of look, we've talked about it here, but this idea that the consumer is concerned, but they haven't changed their behavior. And that, to me, is a real tipping point. We see it in a bunch of different places. We see spending up on credit cards 10%. We see secured debt up 10% for consumers. But then when we look at our applications for debt consolidation, they're starting to creep up. So it's a mixed space. So I thought we'd just sort of maybe dive in. And what I'd love to do is just do a bit of a description of your businesses. So I'm going to start with Mark and Patrick. Maybe we'll start with you, Mark, but maybe just talk about your business and just give us a description of who your customers are and what are some of their challenges.
Well, first of all, I'd like to thank M&T. I know Jonathan personally, and he has helped us out a lot. So you guys do a great job. And the Boston Chamber of Commerce.
I can't attend a venue where Jonathan's name doesn't come up first. This happens to me week after week.
Yeah, he was very good to us, so you should be very proud to know him and have him on your team. Well, so we are a ethnic supermarket in the Boston area. We have a store in Chelsea and 2 in Lynn. I like to say that I am the only English as a first language employee of our company. My wife's family's from Cuba, so that's where the sort of the ethnic bent comes in. I'd like to say, I would say that my life is kind of a Rorschach test, but so I learned Spanish on the fly in our Lynn store. My father-in-law likes to say I speak Dominican, because there are a lot of Dominicans in Lynn. But so anyway, so our consumers are lower income, hardworking immigrants for the most part, warm. They love to eat. I've heard them described as similar to the American population post-World War II. There was a commercial done, the milk mustache. Everybody knows the milk mustache. They tried to do it in California, similar population to our population, Mexican as opposed to Guatemalan, Central American, Dominican, but they didn't understand it because they're like, of course we're going to give our kids milk. Like, why would we not? So they didn't even know what it meant. So anyway, so that's the population that we're dealing with. Like I said, wonderful. I feel like I've been adopted by them. And so just to give you a little bit of background on our business, my mother-in-law and father-in-law left Cuba after Castro took over. So I think my mother-in-law came in '62, I want to say. She was in her 20s. She was really a pioneer in this industry. She had a door in the produce market. First, she worked for Blue Cross for a couple of years, and then she moved there, and she was doing the finances for a company, and she was able to buy in at one point. And if you've ever been into the produce market, even today, it's really man-town. So she was absolutely a pioneer. She brought ethnic products to the New England markets. So, but yeah, so we're weathering. We didn't know there were tariffs. There tariffs, really? I didn't know that. No, so we're weathering them pretty well, but it's challenging times. No question.
Thank you, Mark. That's really helpful. All right, so Patrick, similar question, but you're dealing with folks who, for lack of a better term, are using discretionary spending, right, in your services. So I'd love to hear about the customer, but I also would love to hear about your description of what it was like 30 years ago and how that's changed.
Well, thank you, Renee. Thanks to the Chamber and everyone who came here this morning. We started out in Boston about 44 years ago. I started out selling fake IDs. And
I've got one right here.
True story. And my fake IDs got me into a big nightclub in Buffalo. And then I bounced around operating clubs here and there and landed in Boston and started on a little street called Lansdowne, and would like to, we're very proud of what we've done there, from bringing the Hard Rock Cafe, part of bringing Hard Rock to America back in the late 80s. We co-founded and created the House of Blues, as well as a number of other brands, and we own and operate 47 places in 6 states. We have over 4,000 employees, and on a nightly basis, or on a every morning basis, we have a unique picture of the economic situation, because it's customer spend, and this is really where the rubber meets the road. And what the common theme here that's emerging is the Rorschach test, and I can I want to join that that army as well, because what we're seeing is certainly uncertainty, and it's also the tale of two cities, and what's going on, or two times, if you will. This morning, Renee and I were talking about something as simple as a cup of coffee. One part of our market or environment where people have no problem ordering an $11 Uber Eats delivery of a Starbucks coffee, which is kind of crazy if you think about it. And I suppose if you speak to those people, they're very happy to say, oh yes, everything is, everything is groovy. But then you have the other half of the population, and it probably is half and half, who are outraged by that notion and are cranky about a $4 cup of coffee. And I think that what we're seeing in our business is that, that wild whipsaw between these two markets, between these two types of people. And, if you look at the, the $11 DoorDash delivered coffee customer, then these graphs, are surely supporting what their reality is. But the flip side of it is there's another side, and that's maybe it's the side of discontent, or it's the side of people who, are having a tougher time. And we see it in our business. And back to your question about the hand-to-hand combat, back in the 80s when we operated nightclubs, there wasn't such a thing as social media. There was not an excess of, money floating around and people, blowing money on, $800 bottles of wine and, all the nonsense that can be happening today. And if we had, a Wednesday night, we had a nightclub that held 1,455 people. And if you have a Wednesday night where there's no people, you kind of think, well, wait a minute, we have to eat, and we have to pay our rent, and we have to pay our staff, and we better damn well figure out what we're going to do for next Wednesday and the Wednesdays after that. And we likened it to, hand-to-hand combat. We didn't have social media to lean on. We didn't have, we had to basically ask ourselves, how do we create a better product? How do we treat people nice and kind? And how do we entertain them? And how do we make this work? And it was hand-to-hand combat. And I think today we're closer to hand-to-hand combat in the trenches than we have been in a long time. And I think it's a product of our macroeconomic situation, inflation, interest. I think that our leadership, city and state leadership, is lagging way behind on getting people back into the offices. And the trickle-down effect of that on, everyone from, taxi drivers and bellmen and doormen and dry cleaners and, fruit vendors are feeling it. Everybody knows about the political uncertainty. I hope it hasn't been lost on everybody that people are drinking since the pandemic 20% less than they used to. They just stopped drinking. They stopped going out late. The whole meal period has moved to, people go out and all of a sudden at 5:30, you couldn't give away a table at 5:30. Today, it's hard to give away, it's hard to find somebody to fill a seat at 9 p.m. That's a seismic shift in our industry, and I think it mirrors the concerns and options of people who can, engage in a Netflix binge-watching series while ordering, Uber Eats and, couch surfing. Another...
That was me last night.
That was...
That sounds good.
Another huge issue that we're facing that, nobody, unanticipated consequence of the addition of online gaming. But if you think about discretionary spending, if $7 billion was wagered in the state on online gaming in the last year, where did that money come from? Where does it, it doesn't just materialize, which means if you're making a commitment to do online gambling, which, surely your choice, but it's got to come from somewhere because, we all have finite amount of income. And we also are battling with the Ozempic world, which, believe it or not, has an impact. People are eating less. So, we don't want to be crybabies. These are our challenges. And, we get our nightly reports, so we know how our business is, and we got to fight back, and we got to pivot and figure it out in a hand-to-hand combat method, and we will do it. Those are the headwinds and the bad news, if you will. There's also some very good news for Boston and Massachusetts, and we're highly optimistic that this coming year there's going to be 3 once-in-a-generation events coming to Boston. We've got Sail Boston, the tall ships, which I remember back in the 90s they came. It's a mind-blowing experience. And you're going to have sailors and magnificent yachts, or not yachts, sailing vessels from all over the world. They'll be here. You have the FIFA World Cup and America's 250th anniversary. So those things are once-in-a-generation opportunities, and it's going to make Boston act like a rocket ship on rails. So I hope I answered your question and not too long-winded. Thank
Thanks,
you.
Patrick. We're going to come back to this theme of resiliency, but I think just for everybody for a minute, you have to understand one little thing, which is you're dealing with three people who run enduring businesses, right? So they are the survivors. They've seen a lot. Not everyone has that same level of experience that the three of you have. I thought we'd maybe just jump and just think about all the stuff that's happening on the global scene, the international scene, and then maybe starting with Lizanne, just talk about sort of how that is acutely affecting you. You touched on it a little bit, but what specifically, international is giving you pause or helping you think about how to adapt your business?
Right. Is this on? Yeah. Good. Okay. Well, it's a big question. So, as I mentioned to all of you, being in the apparel and accessory business, we import pretty much everything. So, global trade and tariffs create a very uncertain environment for us. Obviously, we understand and we believe that tariffs are here to stay. We don't think that they're going to go away. We will see. The Supreme Court, I believe, actually today is hearing on it, so who knows? However, we're operating with the assumption that it's not going to go away. What we're thinking about is, what does this mean over time in terms of our relationship with our vendors overseas, how we think about our architecture of our business, how we think about efficiency, what we can pass through, what we can't pass through. And as I said earlier, I think that really at the core of it is the customer will tell us her appetite for what she's willing to do with us in terms of the price. So for us, we're much more focused on solving into our relationship and our reason for existence and why she comes to us. Tariffs are tariffs. We're going to figure out how to solve into it. But it is about thinking about the business holistically and how we serve our customers.
And it's much less, I guess, I'm hearing about 2026 as to beyond. Like, how are we going to reposition ourselves?
It's going to cycle its way through. We're not done yet. I think that is a part of what we're seeing in the economy when we talk about inflation. It hasn't really cycled through when you think about pulling forward of inventories. You think about the fact that everything on a vessel was exempted. So by the time the goods got here, there was a period for us to get the goods out and actually start to impact pricing. So I think that there's a lot of unknown factors around tariffs. I go back to serve your customer in the best possible way and respect that in your business, and then you'll solve into how the business is going to combat. Yeah. I'm going to use your word too, combat. It is a bit of a day-to-day combat, but how you combat the idea that tariffs are now going to be embedded in the cost structure of how we do business.
And so, Mark, you don't have the benefit of, Patrick's in the discretionary spending world. Your world is not discretionary. How are the customers navigating, and what choices are they making?
Well, I think there's a couple things that they're doing. They're sort of buying down, if you will, like private label. One of our major wholesalers, most of our American goods comes from CNS, Wholesale Grocers. I don't know if you're familiar. They're the largest independent wholesaler in the country. We're seeing those prices every day, but they've gone through and they've made a major change with their private label brand. They call it Our Brands, and so they're upping their game there. Just happened to be at this time, and I think it's very good for us. Our consumers already have welcomed private labels, which again is a little bit cheaper. There's not as much marketing money behind it. So it's lower cost than the national brand. Like say Hellmann's might be I don't know, their suggested retail is like $5.99. We don't sell for that. We sell a little less, but the private brands is probably $3.99. Again, a lot of people like their mayonnaise, but that's just an example. You know, I myself will pretty much try any private brand because it's good, it's very good, it's national brand equivalent, but mayonnaise, I like Hellmann's, so that's that.
Yeah.
But what I've been hearing,
we
by
did
the
see
way,
a trade down as well.
Yeah.
Yeah.
what I've been hearing most recently from Goya, actually, is that they're leaving the container ships out a little bit longer, so there's sort of a lag because they're waiting to see if the tariffs change and if they can get benefit from that. You know, also a big thing for us too is just freight. It's not so. I talked to one of our suppliers today, and he was saying that a lot of he does a lot in plastics, and he was saying that they do a lot in India. Could they buy it in America? Yeah, but they'd have to buy 3 containers of it per month, which is just too much for them to handle. They're smaller. They sell to small guys and women. But he was saying that so the Indian company that's making those bags is eating that. But he's like, then the freight is such a huge part of his business, even though gas prices have gone down, and the driver's shortage. That's something that we're seeing. They're paying exorbitant amounts of money to hire drivers. One last thing, and then I'll pass it back to you. But CNS was telling us 2 years ago that they were Amazon opened a warehouse right next to their main hub in Windsor Locks, one of their main hubs, and they were literally putting flyers in their cars of the drivers saying, "We'll hire you. We'll pay you like a $30,000 bonus, and it'll be $100,000 a year at least to start." So they're dealing with that too. That goes right into the cost of consumer goods, and you know we're in a very low margin business. Lizana, you guys are, you know, you have a little bit more margin than us, probably a lot more margin than us. So we have to pass that on to the customer. So yeah.
Yeah, it's interesting. We have a customer out of New York City who runs House of Spice, so that's the wholesaler for all Indian food. And you both touched on it. You know, if you look at the game playing out, what they would say is we won't see the full effect of the tariffs until February, March timeframe. So, you know, amongst all the challenges that you guys talk about, it's not done, right? It's still coming. And I think I'd like to spend a little bit of time just talking about, you know, the topic of resiliency. And these would be from your personal experiences and how you sort of navigate your business through these things. And Lizana, you know, you've had tremendous experience turning around brands, right? That have, you know, needed to have a lot of change, undergo a lot of change. Can you just tell us a little bit about what do you think the key strengths are? What has gotten you through that? What are the skill sets that are required?
Yeah, so thank you for asking that question. That is that's a very big question as well in terms of just thinking about, I've actually had, I don't know if I'd say the pleasure, but I had the opportunity to lead a couple of very, very big turnarounds, businesses that were quite distressed. And so when I think about resiliency and I think about sort of day-to-day combat, you know, there's a lot of learnings from that I apply forward. But I'd say there's probably 3 factors that come to mind for me. One is really about focus and not boiling the ocean. Usually when you're dealing with a business in any way, shape, or form, there's a few things that really, really, really matter. And we do get caught up in today's environment because it's complex and we're leading in a lot of ways, but there's some universal truths that we keep going back to, and that focus and keeping yourself, your team, and the business focused on the few things that really matter relentlessly is critical. Agility. We make a lot of decisions every single day. Everybody does. Many of them turn out not to be right. So having that humility and that agility to go back and revisit constantly and pivot when you see you make a decision, if it's not right, you just flip it and you move forward. And then last, I would say the third component, and you're talking about pointing here, but talent. I can't emphasize it enough, you know, and that's a big topic in today's world because things are changing. So how we think about talent and how we think about the folks that work with us, the leaders that we're all partnering with, our associates, how do we think about talent in a world that's constantly changing, I think. So key takeaways from all these big turnarounds.
Everything is talent.
That I apply actually every single day. I try.
Thank you. Mark, you want to?
I would say talent is huge for us. Our employees we're a family business. Our employees are family. And we've been able to learn so much from them. They're all of our managers are immigrants from one nation or another. And not just the managers, but also everyone in our company feels like they have a say, and they do. We listen to them because they talk to our consumers more than we do. As much as I'd love to be on the floor every day, I'm not. I have to be thinking about the business, not just, working in the business. So I think that's our key component. We've always created a job-hugging environment. I think. I mean, we're still their employers, so it's not perfect, and I'm the first to admit that. But we strive to treat them as family, and I think that they're a front line because that's our value proposition. We're not the lowest cost. It's tough being the lowest cost because there's always somebody who can undercut you. But we try to give good service, and we try to make it close to home. That's our tagline, actually. But we try to make it as if you were in the Dominican Republic or in, Guatemala or in El Salvador. Our employees look like you. They speak the same language. And that's something we've been able to do very well. But that's our business, 100%.
Thanks, Mark. Patrick?
Well, all I can say is, Mark, our tales of woe pale in comparison to yours. You've got tariffs, you've got immigration, you've got ICE keeping people away, and you've got the SNAP payments are not coming around. So that's got to be, all headwinds you have. It makes our business feel like a cakewalk. Though what our focus is, and it's been historic, every time there's been a bad situation, a recession, is our policy and position has always been to spend our way out of this recession. And that's what we're doing right now, oddly. We have an English ale house underway on Charles Street in Beacon Hill.
What's the date you're going to open up? Send us a note.
Send a note. And we have a Game On and a country western place opening in Salem, New Hampshire that we're underway developing, and a King's Bowling venue in the North Carolina. So we like to take advantage of these bad times as a time to expand, and it served us well. In '87 and in the early '90s, every time there's been a downturn, we've, buckled up.
That's very similar to the history of M&T. We've never been pressured to have to grow, so it's made us strong when times were tough, and it gave us opportunities to move to new places, and we like to say get invited into new places that want to do business with us. So we're going to open it up for questions in a minute here. So let me just open it up right now. We'll take the first question.
Good morning. Great panel today. And I think when I come to these events, sometimes I feel like I know less going out the door. I say that to say that 2 weeks ago I was invited to hear a presentation from the economist from BU, Mark T. Williams. I'm sorry. Economist Mark T. Williams from BU. And, Patrick, first, I want to just say that you described the current market very well with the analogy that you used. 2 weeks ago on a Thursday night, I was here in the Seaport and finished an event at 9:30 and had some free time by myself, and I walked around the entire area of the Seaport. there were less than 10 restaurants with more than 25% of people in their seats or at the bar. Some bars were closed, and there's some venues that are in the Seaport that are only open on Fridays, Saturdays, and Sundays now. So things are changing. But going back to the economist from BU, he said that he was one of the 5 people that said that they predicted the crash of 2008. And he feels that by Q3 of next year, that the entire country will be in a full recession. So when I hear about all the stuff that's happening here, and a lot of you just mentioned earlier that a lot of the regulations that have been put in place by the current administration have not hit yet, that's exactly what he focused on. And he said most of those would happen in Q1 and Q2 of next year. And so I just want to know that when you guys look at your current situation, and I know that it's all challenging, and thank you guys for, weathering through the storm. Are you looking out for 6 months from now, or are you just paying more attention to the current quarter?
Yeah, I mean, I'll take that one just for a quick second. So we actually commit to our inventories that we bring in upwards of 9 months in advance. So we are looking quite far out in terms of what we think when we're committing. We are thinking that we're going to feel good by the time we get to Q1, Q2, Q3 next year. There's some tax relief that's going to come through in the first quarter as well. So we're watching that closely. Again, there's a lot of nuance in thinking about how we feel about next year. So we're committing in a way that is, let's call it close to flat, but we're keeping ourselves very flexible so that we can either push out or we can go get more if things turn out to be better or worse. So I think that sort of flexibility when we think about the outlook and we think about the environment is key. But we are thinking pretty far out in terms of how we're thinking about our commitments.
We kind of look at both ways. We have to be immediate because we have to be able to turn on a dime because we can't hold our inventory that long. It'll just go out of code and we'll be in trouble. So, but we are looking to see what's coming down the pike a year, 2 years out, CapEx spending, that kind of stuff. So yeah, we're doing both.
Oh, go ahead, Patrick.
And we're, it's, Daryl, as you know, our business, opening a place is like birthing a baby, all the way through pregnancy. And, we're committed to doing it, and hopefully it's not a suicide mission that we're on, and that by the time next year rolls around, we'll be able to weather whatever's in front of us.
One of the things that's interesting, I think, is that with respect to the consumer and monetary policy, as you look at these segments that are struggling, in all the uncertainty, what is certain over many, many decades is that when the Fed changes interest rates, it takes 12 to 15 months for it to have a full effect on the economy. And so you really are trying to predict not what's happening now, but like where are we going to be, where are we going? And then there isn't the same amount of history with the tariffs, but it's proving out to be very similar in terms of the lag effect that it has. So as you're thinking about things that you need to do for relief, right, like there's some sense of urgency if you believe, right, that things are going to continue to get a little bit more difficult.
Yeah, and I think the big thing that we all have to watch is really the labor markets, like making sure that, people have jobs and make money at the end of the day. That's really the most important thing, right? So I think that's also where we're seeing some relief on the Fed side, right? Like thinking about both sides of the economy. So that's the one we're watching closely.
And the inverse relationship of the AI investment and the jobs that it's going to destroy is an elephant in the room that nobody's really talking about. And that's going to be significant.
CNS just bought maybe 5-10 years ago. Rick Cohen, who's the CEO, bought a robotics company and owns it, and they're using it in a bunch of their warehouses now. So it's actually picking groceries. They were committed to not not let anyone go unless they wanted to leave, if they're retired, whatever. And they have kept everyone on, but it's pretty amazing what this thing can do, and it doesn't get sick, and it doesn't need benefits, so it's tough.
Colleen, did you have a question?
Yeah, sure. Morning.
And Jim, you're going to have to keep me honest because, Jim, I have no idea what time it is. Okay.
Good morning. 10-year Indianapolis Star carrier, age 6 to 16 in Indianapolis, Indiana. A quick question, you talked about adaptability and also AI. You touched on that briefly today. So how are you leveraging AI now, and how do you expect it to be leveraged maybe in the next 5 years?
I think that, even before AI, there's a lot of outsourcing of telephone reception. There's a lot of overseas activity where people are hiring, outsourcing for, $7 an hour, people in Malaysia and Korea, and it's very successful and it works. And I think AI just takes, and it's going to wipe that out. And, how are we it's just, it's going to change the world we live in. And in our business, it's, the beauty of our business is that we're a customer-facing business, and you can't provide what we provide online. So I guess that's a saving grace. It's the same thing with people need to eat, and
Well, they can do it online, though, or they can buy it online. Our proposition is the experience, though. So that's a little bit different. They can't get the experience online. And we've found that, everyone was predicting that during COVID, that was the death of the brick and mortar supermarket. And we've grown consistently through that and beyond that, and we don't do any online retail. AI has helped me write some letters, I think. Yeah, it's not going to change. I mean, it'll maybe make us more efficient, so maybe I'll have more time to, I don't know, go out and bag groceries. One thing I did want to just touch on, this is a little bit unrelated to that, but the food stamps. As you guys all know, it's been cut. Now it's back up to half. But I just wanted to thank the Boston Foundation and the Latino Legacy Fund. We partnered with them. They raised $50,000 to give gift cards to needy families, and Stop and Compare matched that. So we put in $50,000, and they've all been given out to needy families in Lynn and Chelsea. So a big thanks to the Boston Foundation and the I think it's the Latin Equity Fund, and Javier Juarez personally, he really spearheaded that. But we try to give back what we can, of course. Our food stamps penetration right now, it's a little bit early. It's the 4th or 5th of the month. We're about a third of where we usually are, but that can change at any time, even without the 50% inflow. We think, by the way, that a lot of our consumers have some money left over on their food stamps cards. And to give you an example, the penetration for our stores during COVID was about 50% of the purchases by our customers were on SNAP food stamps program. Before, like last month, trailing 12 months, it was about 18 to 21% of our sales. So it's been going down. Our sales have been going up. It's been going down. So, it is what it is.
I would just add that, we have a lot of use cases across our firm. We do a lot of different things. But the thing that actually I most focus on is the idea of protecting everybody's money. I mean, at the end of the day, lots of people can do what we do. They can lend money. But the protection aspect of what a bank does is important. And so it's like an arms race trying to keep up with deep fakes and all the different types of fraud. And just when you go high tech, they go back to checking. And so for us, AI and those tools are going to be essential just to compete in the warfare that is about protecting our customers' assets. So, one last question here.
Hi, my name is Sergio Espinoza. I am from the neighborhood that Mark just impacted with those gift cards. You stole the thunder that I was going to give you. But so yes, Compare being one of those neighborhood areas, what Mark says is very correct, right? We live it every day. We see a lot of the impact that's happening there. But I did want to mention I had a question, right? I feel like technology was brought up and a lot of the thin margins. I wanted to talk a little bit about, how technology is helping us balance what that experience could be. So a lot of times we think about in certain neighborhoods that technology is made more for because it's a luxury, but sometimes it can be convenience. If you're working 80 hours a week, if you can order something online, it makes it a lot easier for you to be able to spend that time with your family. But also might help you a little bit in the labor, right? Technology is not going anywhere. AI is here to stay. We're going to try to use those tools. What are you doing not only in the restaurant industry, and that's important because today, so I'm the president of the Massachusetts Latino Restaurant Association, and we have a roundtable today, so I'm really curious to hear this answered so we can put it out there. I want to make sure that what are you doing to balance that technology so that you're able to get a better experience, but also be able to help out your margins? And does that also involve private label, something like what Kirkland's been able to do, right? Like you have this private label brand that immediately you think of a superior brand. Is that helping you out in the restaurant industry, and is that helping you out also in the regular food industry as well?
Okay, who's going to take this one?
Well, that was a very simple question.
Sergio's full of simple questions.
I think that the fact that we're a customer-facing business, AI is going to fill in the blanks where it can, and it's going to create efficiencies where it can. But at the end of the day, if you think about Cheers, the TV show, it's about, you go into a place and everybody knows your name, and there's a sense of community and kinship and conviviality that you just can't get otherwise. And, our job is to make sure that, we try to do that as best as it can be done to prevent ourselves from all becoming robots.
Let's end on that. Very well said. Thank you all. Nice job.
Thanks.
All right, great. Well, thank you to Megan, Lizanne, Renee, Patrick, Mark. A couple of takeaways. We're in a Rorschach test economy. I think Lizanna mentioned that as much as we hear the word uncertainty, we can expect that uncertainty will certainly continue. And one of my big takeaways, of course, is that while we have always appreciated the resiliency of the consumer, the resiliency of business and business leadership too, which is what each of these panelists talked about today, the ability to just take on what the challenges are, look at what the opportunities are, and pivot in the way that they need to, is one of the ways that our economy here, particularly in Boston and Massachusetts, is going to continue to thrive. So once again, thank you to all of our panelists, and thank you to you for joining us today.